This week we are closing out Chapter 5 and starting Chapter 6. We're nearing the end of the course, but please do not start coasting to the finish line yet, okay? Finish strong. This week, our learning objectives include how to use classified financial statements to evaluate liquidity and profitability. That's from Chapter 5. You can check out Section 5-6 on that one. We're going to be defining merchandising accounting and differentiating between perpetual and periodic inventory systems. That's out of Chapter 6, the early part of Chapter 6, Section 6.2. And then we're going to be describing the features of multi-step and single-step classified income statements from Chapter 6. That's actually a lot more complicated than what it sounds more complicated than what it really is. That's in Section 6-4. Okay, let's talk about these classified financial statements for just a moment. The income statement and the balance sheet help leaders establish some key financial metrics about the organization. And we know this from earlier on in the book. For example, liquidity measures a company's ability to pay its bills when they are due and to provide for unanticipated needs for cash. Two measures of liquidity are working capital and the current ratio. Working capital equals the current asset amount that would remain if all the current debts were paid or the obligations were performed. The current ratio equals current assets divided by the current liability. So it's a ratio. It's called a current ratio of 1, for example, shows that the current ratios are barely enough to settle the current liabilities, where a current ratio of 2 is considered much more satisfactory. So you have twice as many assets to cover all those liabilities. Let's talk about profitability for a moment, another measure. Profitability is the ability to earn a satisfactory income. Now that word satisfactory is certainly a subjective one, all right? But to draw conclusions, measures of profitability must be compared with past performance and industry averages. The 5 measures of profitability that we're looking at least, are going to be the profit margin, the asset turnover, the return on assets, the debt to equity ratio, and the return on equity. Now, I'm not going to go through each one of those, and so you can read about that in the text. Now, as a leader in your organization, you need to understand which metrics make sense for you and be able to compare your organization to others in similar organizations. So, for example, if you're a nonprofit, you would not compare your net profit number to a for-profit business. You'd be comparing the apples and oranges thing. They're not comparable. Okay, let's switch to Chapter 6 for a minute and talk about the nuances of accounting and inventory for merchandising businesses. Now, these would be businesses such as retailers and wholesalers. They buy goods, they hold them or they inventory them, and then they resell them, hopefully at a profit. In a typical service business, revenue is generated by charging a fee for the service. In manufacturing, for example, the company produces a good from raw goods and then assembles, compiles it, puts it together into a new good, and then resells it at a profit. But in a merchandising business, the owner buys inventory and then hopefully sells it for more than the cost of the purchase. So, in a merchandising business inventory, there's an important component of the operating cycle, and that's keeping track of the inventory. It's making the accounting process also a little bit more complex. So inventory is important in a merchandising business. It's important in any business, to be sure, okay? But in a merchandising business, it's an important component of the operating cycle. If you don't keep track of it and you don't sell it for more than you're worth than you bought it for, then you're basically done. So in a merchandising business model, there are 2 basic systems of accounting for the items in the merchandising inventory, or when you're merchandising your inventory. There's the perpetual inventory system and the periodic inventory system. In the perpetual inventory system, it's used when management wants to always have a current inventory balance. The word perpetual, like always, it's always there. What is our current inventory balance? So the idea is you'd be able to hit a button and see what your current inventory balance is. And under this system, inventory records are continuously updated, providing management with up-to-date information regarding inventory levels, and not just the levels, but like the value of the inventory, as well as what are the different part numbers, the different goods numbers that you have in inventory. So it's important for both inventory control and customer service. You don't want to run out of things, for example. But in a periodic inventory system, a physical inventory, that would be like a manual count of inventory by hand, it's done periodically, usually at the end of the accounting period. Remember the term of periodicity, that concept from earlier chapters. So a periodic inventory system is simpler and less costly to maintain, but it does not provide management with that continuous update of current inventory balances like you would get in a perpetual inventory system. And listen, there are advantages and disadvantages to each of these systems. Factors such as the cost of the software and the people to manage the inventory, some of those are the pivotal variables around which leaders need to make decisions. A final step that we're learning, a final item that we're learning about this week from Chapter 6 is the two different processes for developing, presenting the income statement. The income statements presented so far in this course have expenses deducted from revenue in a single step to arrive at net income. So in the single step income statement, the revenue section lists all the revenues, including other income, right? Not just revenue from sales, but any other income. And it includes the cost and expense section, which lists all the expenses, including anything that might be considered other expenses. So in many companies, though, a multi-step form of income statement is more detailed, containing several more subtractions and subtotals. And you can see it here. So it's net sales. That's the sales that you get from all of your revenue that you generate from doing your sales, minus the cost of the expenses to generate those sales, the cost of goods. That gives you what's called gross margin. You take the gross margin then, and you back out or subtract from that your operating expenses. It gives you the income from operations. And I'll tell you, I think the income from operations is pretty important. It gives you an idea as an operations manager how you're managing the business. But then you either add or subtract from the income from operations number other revenues and expenses that maybe you didn't have a lot of control over. You get your net income. So a multi-step income statement goes through a series of steps or subtotals to arrive at net income. And it's used by merchandising companies, which buy and sells products, and as well as manufacturing companies, which makes and sells goods. Now, four major parts of that merchandising or the manufacturing company's multi-step income statement are, again, net sales, cost of goods sold, the gross margin, and the operating expenses. And the advantages of this kind of income statement is that it gives users an opportunity to see specifically how the operation side of the business is managing their revenue and their expenses. Usually continuous improvement ideas begin on the operation side of the business, and that multi-step income statement exposes those relevant operations that need to be focused on. So be sure to check out section 6.4 to learn more about the multi-step process of presenting this type of an income statement. Okay, that's the overview for this week. Make sure you read the last section of Chapter 5 and the first two sections of Chapter 6. And remember, God is on His throne. He's always been there, and He's always going to be. Have a great week.